And I think a lot of the research, if there are graduate students here, a lot of the research should go into trying to understand what were the wrong incentives that these managers and decision makers were facing. I don't know. I know that a lot of managers have most of their bonuses in investment banks and in insurance companies. A lot of their bonuses are in stocks and stock options. For example, Bear and Stearns, which was one of the first companies to go under, apparently most of the equity, or a big part of the equity, was owned by workers of the company. So it seems that they already had the incentives there, but somehow it didn't work. I don't know. Is it possible for people who get these bonuses payments to then short sell the same equity? Perhaps somebody knows here. It probably is possible to do it. If that's possible to do it, then it's really not a risk anymore. Was it undone? If something like that is done, is there any punishment? I don't know. It would be important to first understand what were the incentives of these people, why these stock bonuses with stock payments didn't work. In any case, golden parachutes. It's incredible that, this one, I don't know, I cannot find any page in Andreu's book that would say this is any good idea in terms of incentives, that if they fire you, is then when you get the biggest payment this should be completely banned or I don't know, by law or by stockholders' meetings. And then there's a lot of talk about increasing capital requirements. I don't know. I would like to be sure that the low capital requirements were the problem before increasing them. I mean, a little of what happened of what we know was mentioned in this panel discussion was caused by small capital requirements. It seems it was caused by bad rating, bad incentives, other issues. Higher capital requirements have a cost, and we should balance whether the higher cost of higher capital requirements is better than is lower than the benefits they would bring about. Short-run measures. So this is about things that have been done. I'm nearly out of, so I'm going to go very quickly. One, there were a few things that could have been done in the last 2 months. One of the things that was entertained, especially in economic forum discussions, was just let the firms that did badly, let them fail, and otherwise we have a moral hazard problem. But this is a risky policy to take, because there is a small probability of a very bad outcome. There's a small probability that we have a Great Depression. Maybe we won't have it, okay, but maybe we will have a Great Depression. So whenever there is a small probability of a very bad event, we tend to be conservative. And so it seems that letting just fail these companies was too risky, and the consensus was that governments had to come to the rescue. It seems that there is the consensus that this is what had to be done. Paulson's first plan of buying toxic assets there's a consensus, it was a very bad idea. At what price do you buy assets that everybody knows they are bad? This is a very bad idea, but it seems that this is what the French government did with Crédit Lyonnais. So, anyway, I'm saying this because sometimes Europeans make fun of US policy actions very quickly. Things like this have been done in Europe. I don't know if we know here what was the cost of Banesto's affair in the 90s. So, things like this have been done. The governments have been just taking the costs of bad investments from banks to avoid them going under, but to avoid the banks going under. But the issue is at what price do you buy these assets? How long does it take to do it? we would be subsidizing the ones who did the worst. So then Brown's plan a week or two later came out, that's just by equity of banks, so that they take care of their own mess. No? The price of stocks is a much easier thing to evaluate. And the Spanish solution giving avales, what's the name of avales in English? I don't remember. I never took an aval in the US. So it's better than Paulson's first plan, but it has the problem of at what price these assets will be bought. No? The Spanish plan is to buy quality assets, but the Bank of Spain, 3 or 4 days ago, somebody at the Bank of Spain must have gone, oh my God, now we have to price these assets. And there were some complaints about the Bank of Spain that they didn't know what their role would be in buying these assets. It's a very, we'll see how they manage to find a price for this. So another long-run measure, nobody has discussed this, but maybe we can start discussing it, is, okay, so we realize we can't let them fail. We just said we won't. The society said we won't let these institutions fail. So in one way or another, we are subsidizing these firms. This is a big failure of our economic system, that we have to subsidize banking institutions, okay? So if we do it, and we do it, then we should be clear about it. We should, at some point, the Fondo de Garantía, how do you say it in English? The fund to guarantee deposits was established about 100 years ago, was it? It used to be that if you had a deposit in your bank, you could lose the deposit. But then there was a fund established so that wouldn't happen, that if you had a deposit, it was guaranteed. If we are going to subsidize these banking institutions, we should be clear about it. We should start raising funds for when that happens. We should make sure that any equity purchasing or any toxic asset that's purchased is purchased from this fund, and it should be clear where these rescue operations, how much they cost. The revenue should come from banks' taxes. I suppose it would make more sense to collect them from corporate taxes and not from VAT taxes. There was a news a few days ago that maybe banks would pay more VAT in order to fund these rescue operations. I don't think this makes much sense. It punishes those who are more active. Very quickly, what's the problem with the stock market? The stock market is intrinsically very volatile. Just think, the price of a stock market with risk-neutral agents is the discounted sum of dividends expected. If these are the dividends, there's a unit root with a drift A. The solution any undergraduate in Pompeu Fabra or Autónoma knows is this price. No? You just compute it. Boom, it's a very simple formula. This is the fundamental price of this stock. Okay? It's very easy. Not so easy. It's only easy under rational expectations. So here I bring some work that I have actually done. That formula is very easy to compute under rational expectations. Let's say agents don't know A. A, remember, is the growth rate of dividends, the growth rate of the economy. Let's say agents don't know it. Then the correct formula is this one, is the expectation of this ratio, where A is not known, it's a random variable. And you take this expectation depending on the posterior expectation you have formed about the parameter A. Okay, so you estimate A. And this is then a random variable. Now, what's this integral? It's infinite, because you divide by 0. Okay? A cannot be negative. You divide by 0 very easily. So, let's say the point is, this simple formula tells us that a very small probability of A being very close to delta inverse, or a little bit far away from delta inverse, is the difference between infinity and a much lower number.